Okay, so having understood the accounting assumptions and the principles and various concepts in accounting, let us get to the core part of this course, the financial statements. In this video, we're going to look at the three important financial statements and we're going to understand how these are different from each other. So, what exactly are financial statements? In simple terms, financial statements are financial reports which are made from the accounting records of the business. They contain two things. One is it contains a summary of the business's performance. That is, how has the business been performing? Is it profitable? Is it making losses? And so on. The second one is the financial position of the business as at the date of the report. Now, please note that these two things are very important for you to understand financial statement. A performance is usually for a period while the position is as on a specific date. I will explain these two concepts during this lesson. Now, we all know that accounting is a language, and this language about a business is communicated to the stakeholders through this accounting records or the books of accounts. What do these books of accounts state? Accountants usually communicate the performance and position of the business to the owners of the business using these books of accounts. Let us understand this using a very simple example. Let's assume that what you see on your screen is your business. You have a set of eggs, and these eggs hatch into chicken. And chicken again lays more eggs, and this is your story. This is the story that is being communicated to the stakeholders. Now let's assume that a part of these eggs actually belong to a neighbor, and therefore whatever profits that you're making or whatever eggs that you're making in this case, you need to pay a portion of that to your neighbor to compensate him for the eggs that he has borrowed. So as the owner of this egg farm, you would like to understand a few things. How many eggs do you have? Are the eggs increasing or decreasing? And so on. So in order to understand this, accountants usually prepare a small table. This table has two sides. On one side, it shows how many eggs we have, and on the other side, it shows where they exactly came from. Now, we all know that they came from two sources. So let us divide the right side into two. The top portion is the borrowed portion, and the second portion, the bottom portion, is the owned portion. Let's assume that we had 100 eggs. We had 100 eggs at a specific point of time, out of which 30 eggs were borrowed from the neighbors and 70 eggs were owned by us. Now, what happens when an egg is laid? What happens when an egg is laid in your farm? There are two things that happen. On one hand, which is on the left hand side, the number of eggs you have increases by 1. On the other hand, since your farm has been instrumental in making this egg, or rather, in other words, since the egg has been laid in your farm, you own this egg, and therefore the number of eggs that you own increases by 1. Let us look at the flip side of this. Assume that 2 eggs are broken during a specific period. So on the left hand side, the number of eggs you have decreases by 2, and on the right hand side, since the breakage has happened in your farm, you take the ownership for it and you subtract 2. So if you look closely, on both sides of the table, we have 99. On the left side, we have the number of eggs that are there in the farm, and on the right side, we now know how and where they came from. Let's again assume that on a specific day, 10 eggs were laid. So on the left hand side, the number of eggs laid goes up by 10, and on the right hand side, the number of eggs goes up by 10. So we have 109 on each side. Now, since we have so many eggs that have been laid during this period, let's assume that we have decided to pay off 2 eggs to our neighbors. So the number of eggs that we have goes down by 2, and the number of eggs that we owe to the neighbor goes down by 2. And therefore, what was this at the beginning is now this. So 100 has become 107. And similarly, 70, that is the number of eggs that you own, has become 79. And the borrowed eggs has gone down by 2 because you repaid them. Now, How did the business do between these two dates? How did 70 become 79? In our case, it's very easy to ascertain because we had very few transactions. But assume a complicated business where there are thousands of transactions every day. So in order to explain this difference of how your owned eggs increased or decreased during a specific period or during two dates, accountants prepare one more statement which shows the number of eggs laid and the number of eggs broken. So when an egg was laid, it increased by 1. 2 eggs were broken, it decreased by 2. 10 eggs were laid, it increased by 10. And therefore, this is the reason for which 70 became 79. Okay, now imagine seeing a movie. Imagine seeing a movie where you have an opening freeze, then you have a flow of events, then you have an intermission or an interval, then again you have a flow of events, and again a closing freeze. In accounting terms, if you apply this logic, the freeze or the snapshot is called a balance sheet. The flow of events between two balance sheets, like how we saw between 70 and 79, is called the income statement. So what is a balance sheet? Let us understand that. This is very, very important. A balance sheet is a simple summary statement of what the business owns, what it owes, and what it is worth today. Do you remember the first table that we drew? On the left hand side, we had the number of eggs we owned. On the right hand side, we had the number of eggs we owed to the neighbors and what is worth or what belonged to us. So that is nothing but a balance sheet. It is a snapshot of the business's position. The key word here is the position. Balance sheet always shows a position at a given point in time, and it is therefore called the statement of position. So what does a business own? Typically, it owns items like land, building, equipments, inventory, cash and bank, and so on. So in financial terms, the list of things that business owns is called asset. These things are called assets. So whenever you hear the word asset next time, it means it refers to a list of things that a business owns. Assets are also rights that a business owns. For example, rights that have monetary value. So if you have a right to collect cash from a customer who owes you money, it is also an asset. Next, what does a business owe? It owes amounts payable for purchasing materials, things such as salary to its employees, amounts borrowed from the bank, and so on. In accounting terms, these are called liabilities. So things that you own are called assets, things that you owe are called liabilities. So the next time a financial guy or a CPA talks about assets and liabilities, he or she is referring to the things owned or the things owed. So what is left over in the business after paying off the liabilities is the worth of the business. In accounting terms, this is called equity and it belongs to the owners. So let's assume that I have a business where my assets are $1,000. I have liabilities of $800. Then my business's worth or my business's equity is 1,000 minus 800, which is $200. I hope this is clear. And in case it is not clear, I request you to go back to the beginning of this session and go through this lecture again, because understanding of balance sheet is very, very important to read a financial statement. Let us move on. What is an income statement? If you recollect the story of the eggs, we drew two tables. One was the balance sheet representative, which had the things of what we own and what we owed. And we also drew another small table which showed the movement between 70 and 79. So income statement usually shows revenues, costs, and expenses of a business over a period of time. This records all the events during this period, similar to the movie effect that we saw earlier. And it is for this reason it is called statement of performance. Revenues, expense, and costs are recorded on an accrual basis. This is something that we learned in an earlier lecture. So an income statement is a simple summary of what the business has earned and what it has spent. And therefore the difference between what it has earned and spent is called net income or profit. This is also something that we saw in an earlier lecture. The third one The third financial statement is called a cash flow statement or a statement of cash flows. Now, as I told you earlier, the income statement is prepared on an accrual basis. So let's assume that you want to know how much cash has actually come in and how much cash has actually gone out. The statement that you need to see is not the income statement, but the statement of cash flows. It shows a summary of all cash inflows and outflows during a period. And while the income statement records transaction on an accrual basis, the cash flow statement records transaction as and when cash is paid or received. So to summarize, we have three financial statements: the balance sheet, the income statement, and the cash flow statement. The balance sheet shows what you own, what you owe, and what you're worth. The income statement shows what are your revenues, what are your expenses and costs, and what is your profit. At the same time, the cash flow statement shows you the cash inflows, cash outflows, and the cash balance. So summary, we saw three financial statements: the balance sheet, which is also called the statement of position, the income statement, which is also called the statement of performance, and the statement of cash flows.